Okay, so today we're going to do IAS 12 in this video, which is defer tax or a taxation. So this video that I uploaded first is an introduction to deferred tax. Is very important before we deal with a difficult transaction of deferred tax. You must be able to understand the principles so that when we go deep you won't have a problem. So once you understand whatever that we are going to do on this video, I don't think you will still have a problem with deferred tax, as long as you are not claiming anything, but you are making sure that whatever the principle that I'm going to do, you understand deep down. Okay, so firstly, you have to ask yourself the question, why do we have this standard? Why do we have IAS 12? Was it necessary for curriculum developers to do IAS 12? All right, we have to find that out first. Okay, yes. The reason why we have a deferred tax is because of clashing rule between the taxation and accounting principle. So those who are studying taxation and those who are studying with accounting, together with accounting, they know that some of the rules that we use when we prepare financial statement in accounting is not the same rule that we use when we prepare taxable income under Tax Act. So there is some principle that are not agreeing in terms of taxation and accounting. In other words, taxation can say no for specific item, and in terms of accounting, the IFRS say yes. Simple means that the rules are not matching, which means that in that case there is a different. That's what we call deferred tax. Okay, that's where deferred tax arise. Okay, so if accounting and taxation use the same standard, we will not have deferred tax. That's true. If the principles of accounting and taxation were the same, there was not going to be a need for this standard. But because the principle of accounting and tax are clashing, we have to deal with IAS 12. So this IAS 12 standard is very important. Okay, let's proceed. So deferred tax comprise of two categories that you have to know. Number one is temporary different. Number two is permanent different. Okay, so do you have to worry about the temporary different? Yes, because that's where deferred tax arise. But on permanent different, there is no deferred tax that you are going to calculate. All right, I think you will understand this when we proceed. All right, so some important hint that you have to know. Number one is a general income paid during the year. For example, a rent income. So what I'm trying to say in this part is that if a company paid received a rent income for 12 months, which means that when we record on our income statement under accounting, we are going to record the whole of that amount. Even on taxation, they are going to record that amount as it is, has been received during the year of assessment, which means in that case we will have a permanent different. Why? Because what they record on accounting is the same as what they did on taxation. So there won't be any deferred tax that will be arise in that case, because the principle that they use, they are the same in this case. So number two, general expense paid during the year is the similar with the first one. This one is an expense. So if those expenses paid in their current year, it will fall under permanent different. The reason is the one that I was explaining, because on accounting and on taxation, they use the same principle. They both recorded it at the same time. So which means that there is no any difference that will arise. Okay, now let's proceed. Number 3. In accounting, we calculate depreciation, while in taxation, we do not have depreciation, but we call it wear and tears. So those who are doing taxation, you know very well that in taxation, we don't calculate depreciation, but we call it wear and tears. Okay, in addition, remember, when we are dealing with the taxation, there is no residual value. But when we calculate the depreciation under accounting, we have a residual value. So that will make a temporary difference, because the calculation will not be the same. And remember, the estimation year in terms of accounting standard is not the same with the estimation year with the taxation. For example, in accounting, we can have a building which we estimated that the depreciation will be 10 years, but in terms of taxation act, they can use 20 years to calculate wear and tears, which means that these two expenses will not be the same amount. Simple means that there will be a rise of temporary different, which we have to account for. This is what we call deferred tax. Okay, let's proceed. Number 4. In accounting, we have an impairment loss, while Tax Act does not have such thing. If you still remember, when we are doing taxation, you will never find the word impairment. There's no such in taxation. They don't know anything about the impairment. Impairment, we only account it in accounting in terms of IAS 36. Okay, so this will make a difference, because what has been recorded in the books of accounting is not the same as what has been recorded in the books of Tax Act for taxable income. So there will be a rise of temporary different. There will be temporary different, which we have to fix. It's temporary because we have to do what to fix it. All right. Then let's proceed to number 5. Remember, you also have to know, when you fix this temporary different, is it going to be assets, because is it going to be liability? That's very matter. Then we're gonna do it. Don't worry about that. Then number 5, note that according to Tax Act, they account only what is due during the year of assessment, or we call it current year. So when we are talking about tax, they only account what has been paid or what has been received in that year. But in accounting, we also record what has been received in advance. We also record what has not been paid in our balance sheet. Okay, then look at these 4 key. I'm sure you are familiar with these words. We have, in accounting, we have income received in advance, we have prepaid expense, we have accrued income, we have accrued expense. You will never find this word in taxation, which means that there will be rise of deferred tax because of these 4 words. So if you find the transaction with this 4 words, know that it's temporary different. Okay, let's proceed. So remember, the main object is to determine if it will be an asset or liability. You must be able to analyze in form of table and be able to do deferred tax journal. Okay, so I show example of journal. It's only 2 journals in deferred tax, only 2 journal. Okay, then hint, if it's an asset, debit deferred tax which presented by statement of financial position, and credit deferred tax which represented by P&L. So in other words, you debit and credit deferred tax and deferred tax, but if you don't show in a bracket, you're not going to get a marks. You must show that, alright, if it's an asset, of course you have to debit SFP to show that as an asset has do what? Has increased. Then if it's a liability, you know that liability increase on the credit side, which means that your SFP must be on the credit, then the rest is P&L. Simple as that. But remember, you have to do this journal after you have been able to identify whether an item is an asset or is a liability. That's what we are going to do now. Okay, let's go to the question and try to analyze it. Okay, it was question 2 from special exam. Then Afroc Limited is a company that operates within Limpopo province. Afroc Limited has 31 December reporting period, and the information below was extracted from the financial record of Afroc Limited for the reporting period end 31 December 2018. Then statement of financial position has shown the following. Machine with the cost price on 1 January 2018, 550,000. Depreciation, they use 5 years straight line basis. Capital allowance, this is the principle of SARS, of taxation. So they said when SARS calculate wear and tears, they use 3 years, but accounting, in terms of accounting on depreciation, they are using 5 years, which means that they will be different in this case. The depreciation will not be the same because the useful life that they are using is different. Okay, let's start with machine. Okay, the amount is 550,000. We have to find out how much depreciation for this year and how much wear and tears for this year. Then we will do the temporary different. Okay, let's go. This table, you must know it in and out. You must know this table in and out. Okay, then number 1, we are doing equipment. Carrying amount was 550,000. Even on tax base, they started with 550. This is the beginning of the year. Then number 2, we have to do depreciation. Okay, we don't call it depreciation because we still have to do it on the tax base. We call it movement. Alright, then in accounting is depreciation, which we have to say 550 multiplied by is 5 year, which means that we have to divide by 5 year. So this machine was there since 1 January until December, which means that we don't account for months. It will be 12 over 12. Then depreciation is going to be 110. Okay, we have to show by brackets to indicate that this was an expense. Okay. Then under tax base, remember they said is 3 years. Okay, which means that we have to say 550,000 divided by 3 years. So the answer will be 183. 183. 33. In this case, of course, there will be temporary different because the amount, they are not the same. Yes, that's the amount, they're not the same. So which means we have to say 183 minus 110. Then we get temporary different of 70, 73, 333. Alright, the current amount had no different. Alright, so this is the temporary different. Then after that, you have to calculate what? Deferred tax. You have to say 173 multiplied by 28%. Then you will get a deferred tax of 20. You must do calculation on your side because I'm using cell phone to calculate. Okay. Then here it is. This is the deferred tax that we have calculated. Then now the question is that, is it an asset? Is it a liability? Okay, let's try to analyze this one. Okay, let's check what happened on the tax. Okay, they calculated the wear and tears of 183. In other words, they deducted more expense because wear and tears is an expense. They deducted more expense, which means that if they deducted more expense, simply means that the income that they left with, it will be very small. It will be very small. All right. So this means that in terms of tax, they calculated, they take more. Okay, apology for that. I was answering the other call. Okay, let's proceed. So in this case, all right, let's analyze it using the current amount. I think it will be clear better than text based. Okay, so in other words, what happened in this case is that the company has claimed less expense, which means that if they claim less expense, they receive a higher income instead of receiving lower income because they're supposed to claim 183. So this simply means that company is owing SARS because they receive more income instead of receiving what? Less income. They're supposed to claim 183,000. Now they claim 110. Remember, SARS is always right. SARS is always right, which means that in this case we will be owing what? SARS, because we receive higher income instead of receiving lower income. We receive higher income because of claiming lower what? Expense. The more the expense is low, the more the income is high. The higher expense, the lower income. That's the principle. So in this case, we will have a liability. Liability. So remember, this transaction is very flexible. It doesn't stay constant. Sometimes you will find that the current amount is high and tax base is low under movement, which means that in that case will be an asset. So each component has its own rule, guys. Please, it doesn't mean that the carrying amount, if it's low in every transaction, it will be liability. No, if you do that, you are going to fail. If you do that, you will fail. So please make sure that you understand each principle from each component. All right, now we are done with the component of um, depreciation. Let's move. Equipment. All right, the cost price on 1 January is that amount. Then depreciation is 3 years. Then wear and tears. Year 1 they say they claim 50%. Year 2 they claim 30. Year 3 they claim 20. So there will be temporary different in this case, because on wear and tears they are claiming the different amount, and on depreciation they are using the constant amount of straight line for 3 years. Okay, let's start with depreciation. Is 855,123 divided by 3? Yes. Then in accounting is 285. Okay, this one is also movement. You can start by the cost price. Alright, the movement, if you calculate by 30 and divide by 3 years, it will give you 285,000. Okay, then tax base. Let's go and read tax base. Year 1, remember they said this equipment on 1 January. So simply means that this is the first year of this equipment. So if you have to check that when did they purchase this machine, because in other transactions they will tell you that this machine has been purchased in 2016 and now we are doing 2018. Simple means that you are going to use 20% because it will be year 3 for this machine. So in this case it's year 1. So it's going to be 855,000 multiplied by 50%. 50%. So it's going to be 427 500. Okay, show brackets. So in this case is the similar with the previous one. So the company receive higher income instead of low because they claim lower expense. Then the temporary difference, it will give us liability to 85,000 minus 475. Then the temporary is 142,500. Then deferred tax, you have to say 142,500 multiplied by 28%. It will give you 89,900. Then the class is liability. Okay, let's proceed. Then statement of profits or loss show the following. Then received from CAPITEC Limited for service to be rendered in March 2019, taxable in 2018. Okay, then in this case we have received from CAPITEC Limited for service to be rendered in March 2019. This is income received in advance. Okay, then number 2, rent expense for 1 quarter of 2019 paid in advance. So we have income received in advance, and we also have prepaid expense that has been paid in advance. Okay, let's go back to those four categories that I introduced to you. So remember, you don't know which one is coming, and you must know all four of them. Two will come. Alright, so if you still remember, if we receive income received in advance, we haven't performed anything, which means that we still owe the person who pay us. This is a liability. This transaction recorded as a liability. Then expense that we paid in advance, which we haven't used that expense, is an asset, because if that person does not perform that expense to us, we can be able to claim that amount back. Then accrued income is an asset. This is the person who is owing us. We have a power to collect our money. Then accrued expense, we are owing, which means that this is a liability. So these categories that I write in this table is a normal transaction that we do in accounting. So I want you to take note of this. You know that if we receive something, it's an asset to us, ne? Which means we must give SARS something. In other words, we must pay SARS. Because we receive something, then we must pay SARS. That's the rule. Then if we paid something, if you still remember those rule of VAT input and VAT output, they are very similar. If we paid something, we must claim something from SARS. Okay, I think from this one you can be we can be able to analyze so that you can understand where we are going now. All right, if we receive something, let's start it here. If we receive something, it's an asset to us. It's a bank, right? Then the principle say if we receive, we must give SARS, which means that if we receive is an asset, but when we give SARS, is what is a liability. So if we paid something, in other words, we paid something, it's liability side, because we don't owe anything from that part. Then we must claim something from SARS. This is going back to what? To an asset, to be an asset. All right. So in other words, what I'm trying to analyze in this part is that whenever you find income received in advance, because you know that is a liability, when it go to deferred tax, it must be an asset. If it's a liability, it must go back to what? To assets. Then, if we receive something, it's an asset. Simply means that when it go to deferred tax, please make it liability. In other words, liability, a normal transaction of liability, when we calculate deferred tax, it must be an asset. It's a vice versa. Simple as that. If we receive something, we must give SARS something. We only claim something from SARS if we paid something. Simple as that. That's the rule that will assist you to understand this four component. Okay, now let's go back to that question. Number one, we have income received in advance of 250. Okay, income received in advance, okay, is 250. Yes, under books of accounting is recorded. But does SARS know anything about that? No, they don't have those forward, which means that the temporary difference will be 250,000. Then now we have to calculate deferred tax. 250,000 multiplied by 28 over 100. Then the temporary deferred tax will be 70,000. Now the category, is it an asset? Is it a liability? We are dealing with income received in advance. Let's go back here. In normal transaction, income received in advance is a liability. Simple means that when we go to deferred tax, it will be an asset. Simple as that. If you use this principle, you will never go wrong. You will never go wrong. Okay? Then let's proceed. Rental expense for first quarter of 2019 paid in advance. This is prepaid expense. In other words, we paid in advance. In normal transaction, this is an asset. If you still remember, prepaid expense in normal transaction is an asset. Simple means that when we go to deferred tax, it will be opposite 167. It will be opposite 167,000 prepaid expense. SARS know nothing about this. As I explained, 167,000. Then now let's go to deferred tax. 167,000. You just punch 28%. Then you will get 46,760. Now the question, is it an asset? Is it a liability? In normal transaction, it's an asset. Simple means that in this case of deferred tax, it will be liability. Simple as that. Simple as that. So this is how you should compile your table. Then let's go to the journal part. Okay, let's start with the first one of movement. We found that it's a liability. If it's a liability, which means that you have to debit deferred tax, which in brackets you have to say P and L. Then the amount is 20,533. Okay. Then what do we credit? Deferred tax. Deferred tax. In this one is SFP. Then the amount is 20,533. Okay, so this is how you should do the journal for deferred tax liability. Because liability increase on the credit side, SFP must be credited. If it's an asset, all right, let's go to income received in advance. This other one will be the same. Let's go to income received in advance. You are going to debit deferred tax, which is SFP. Why? Because an asset increase on the debit side. All right, 70,000 thousand, and credit deferred tax PNS of 70,000. So this is how you should compile your deferred tax journals. So other than this, you will find that sometimes your deferred tax journal that they are saying you should prepare has only 2 marks, which means that in that case they are looking for only one journal, which means what we have to do, you are going to add an assets one 70,000, then you less every liability, which means that the amount that you're gonna left with, in this case it will be liability, then you do the amount of liability as a balance, then you will do only one journal for that case. So I'm gonna do other video for deferred tax. So basically this is an introduction, and this video is for you to understand how do you allocate assets, how do you allocate liability, and so on and so on. So we're gonna do other video which will be PPE, including deferred tax. Alright, so you will watch out for the next video. Thank you.